as we kick off 2023 here. We've got some new tax laws I wanted to go over with you. And I think it's pretty interesting what they're doing with some of these rules around taxes that they're putting in place. 2022, a lot to say on 2022, but I'll talk to you about that either in one of our calls or some other type of communication. But right now, I just wanted to kind of look at the tax implications with this new Secure Act, the Consolidated Appropriations Act of 2023 by Joe Biden and company. Let's take a look at it and see how this is going to impact you, my clients. First of all, we got changes to the required minimum distribution. This will affect many of my clients. And so if you're born between 51 and 59, the new age to begin taking the required minimum distributions is now going to be moved up to 73. And since I've entered this industry in the late 90s, we have seen the age for men go from about 70 to 76, and for women go to 76 to 80. And so the expected life of both men and women in the US has gone up for men almost 10% in 20 years. So we look at, if you're born 60 or later, the new age is now 75. The penalty for taking them, for not taking them, has been reduced from 50 to 25%. And then if it's not taken in the year and further reduced to 10%, then the mistake's corrected in a timely manner. So if you don't take it like you're supposed to, and you correct it in a timely manner, it's only a 10% penalty. So most of all of you are doing that, and we make sure we get that in a timely manner. So, and if you've had RMDs for 2022 or earlier, we're just going to keep doing what we're doing. So this does not apply to you. Effective in 2024, I really found it interesting that RMDs are no longer required for Roth accounts and qualified plans. So we've known that Roth IRAs didn't have RMDs, but now they're applying that to 401ks, 403bs, and all other types of after-tax qualified employer retirement plans that you would have if you were employed. You would have those type of plans. Also, employers can now make contributions to a retirement Roth account, like a Roth 401k. And in that particular example, the employer could, a Roth 401k, they could contribute up to $43,500 on top of the employee's contribution to take it all the way up to $66,000 per employee. So that's a nice feature there for those of you that are wanting to put more money in Roth retirement plans. And many of you do. And those are becoming more and more popular now, I think, as people become more and more nervous about socialism in the future and higher taxes. We're seeing Roth retirement plans become vastly more popular than they were 10 years ago, 5 years ago. So also we can have Roths now with simple and SEP IRAs. So the popularity of the Roth continues to grow. And as people live longer, as we continue to be uncertain about taxes, we can continue to see the Roth popularities increase. In the future, 529 plans will be able to be converted to Roths, and there'll be no taxes on it, but you got to wait 15 years. This is something that I don't think applies to a lot of my clients. We don't talk a lot about having 529 plans that haven't been used in 15 years, but for those that do, it'll apply. Spousal beneficiary update: as your spouse passes away before you, they have an IRA, you can, still roll the assets into your own IRA. You can treat the account as your own, and you can remain the beneficiary, or you can just remain the beneficiary on the account. In 2024, you'll have the ability to be treated as the deceased spouse. So that means RMDs will begin later if your deceased spouse is younger than you. And also the survivor spouse's beneficiaries will be treated as if they were the original owner's beneficiaries. So that will speak to what their withdrawal schedule will be if they're the surviving spouses. If they are the surviving beneficiaries of the spouse that survived. It gets a little complicated, but that's, I think, pretty gives more flexibility to spouses for those of us, and many of my clients have spouses with IRAs, of course. So this gives even more flexibility to that, and more benefit, I think, a little bit more. 2024, the 50 plus cash up amount will be indexed for inflation in increments of $100. So previously it was just like a flat 1,000. Now for 50, if you're over than 50, and many of my clients are, you will have to start, not have to, you will have the ability to start giving more than just an extra 1,000 a year. And then they added this one, which I like a lot with people living longer, because I have clients that are working into their 60s, and I'm seeing that this could be a need. You'll be able to now put money into your retirement plan, deduct it from your taxes, and it can be 150% of the current regular year catch-up amount. So that's pretty substantial when you look at what you can do in a 401k with already over the age of 50. Now we're going to multiply that times 1.5. For those 4 years, you can put in quite a bit. So you could work those 4 years, work till you're 63 and put in all that money. And then when you retire, you can pull it back out and you won't be taxed at what your income was when you were employed. So it'd be a lower tax rate. You put it in your 60s, a lot of it. And then when you retire, let's say you're 67, 64 or 65, whatever, and you start pulling money out of your IRA, it's going to be a lower tax rate because you won't be making as much as you made when you're employed. And when you're employed, you got to deduct it. So I like this one a lot, especially since it's quick. It's almost like you put the money in, 5 years later, you take it out. Beginning in 2024, the maximum annual qualified charitable distribution amount is going to be increased to 100,000. I do have clients that use this. The bottom part here is about a charity where income from these trusts are still going to be treated as ordinary income. You can go up to 50,000 on some of these qualified charitable trusts. It's something that you can do to leave income to beneficiaries. But the main thing up there is in 2024, you can now distribute. If you're over the age of 70 and a half, which you got to be, you can distribute your IRA distributions as a qualified charitable. It goes directly to the qualified charity. So, and you don't have to report that money from the IRA as income. This is a great tactic. If you're over 70 and a half, talk to me about this one for sure, especially if we have money in your pre-tax 401k or traditional IRA. Penalty-free withdrawals, they give you a lot of options here. I don't work with a lot of firefighters or forensic security employees or correction officers. However, I thought this was nice that they're going to let these folks take money out penalty-free from their retirement plans. This one's a big one, actually, for my self-employed clients, and I have a few solo 401ks set up over at Schwab. This is nice. You can now set these up as you would like an IRA. You can set them up after the turn of the year. So in other words, if you wanted to set up a 401k for 2022, you could do it all the way until, April 15th of 2023. And solo 1Ks are nice because it goes back to now, let's say we get back into the whole, now you can do a solo Roth 401k. You can now contribute 66,000 for yourself and 66,000 for your employee for a grand total of 132,000. If you're under the age of 50, if you're over 50, it's even more. And if you're over 60, it's even more. So this is beautiful for those that are self-employed and high income earners that are really able to live below their means and sock away 100,000 plus per year. And as you get into 60 now, these new rules, it gets to where you can save, you're closing in and approaching 175, 200,000 a year in these plans. This gets into the shortfall statute of limitations on RMD shortfalls if you don't take out enough. And then they're talking about income annuities, making sure now that it's much easier to report on those. So the government's not coming down on you if your annuity doesn't follow the RMD rules. We don't get a lot of that. We're usually able to stay on top of that. But for a lot of people, particularly that aren't working with a financial advisor, it happens. They have to go back in, get audited, redo their taxes, and pay penalties when they were having incomes from annuities coming in, and it was messing up the calculations on the RMD. So now they've got some friendlier rules with that and how they're looking at annuities that are inside of qualified retirement accounts. Beginning in 2024, we're going to have employers will be able to match amounts paid by participants towards their student debt. So I think this is something that is going to allow students to get out of debt faster. The employers will, if they want to, they can help the students get out of debt faster. And this is probably actually going to be probably a lower tax if you look at it. Of course, one could say, well, if they help the student get out of debt faster, the student's going to start having higher income. So anyway, I think in the immediate term, this is going to be probably a lower tax as we look at this, and it's going to give students the opportunity to decrease their debt faster and maybe produce some loyalty to their employers. Employers 50 or fewer employees will now receive a retirement plan startup credit of up to $5,000 each year during the first 4 years of the plan to offset the actual cost of implementing the plan. I wonder if you have to actually have receipts for these to get the credit when you're starting it, or if it's just like 20 grand those first 4 years as a credit to your taxes. If that's the case, that's pretty good, really good actually, to be able to get a credit like that. As you know, credits are a dollar for dollar reduction in the taxes that you owe. They're the most powerful of all tax benefits, or as a tax credit. Much more powerful than a deduction, anywhere from 60 to 80% more powerful than a deduction. Taxpayers can now establish SEP IRAs for their household employees, family members there. Those are really kind of the things that I wanted to go over with you. I think as you look at some of those, if they apply to you, call me. If you don't call me, we'll talk about it in your financial planning meeting or your tax planning meeting if you're a wealth management client. And we'll continue to keep an eye on these things. Hope you guys are off to a great start, healthy, and making goals for yourself and for your family that'll be able to last forever.